of MFRS 108 in slide 27. Okay, this is an example of changes in accounting estimate and how you are going to do the adjustment. Okay, remember changes in accounting estimate must be done prospectively. That is, the changes take effect in the current year and the subsequent years. Here we do not adjust the opening balance from previous year because it is a prospectively, it is only effective in this year and in the subsequent years. Okay, so the example on 1st January 2009, an equipment costing 5 million with a residual value of 500,000 was acquired and depreciated over 10 years on a straight line basis. So I have summarized the information here. Okay, in January 2012, equipment will be depreciated at 25% per year based on the reducing balance method. So here there is a changes from straight line method into reducing balance method. Okay, you may see that this is like an accounting policy, but it is true that any changes in accounting policy must be done retrospectively, but changes in a depreciation policy is not treated as change in accounting policy, but it is treated as a change in accounting estimate because the depreciation itself is an estimation. Therefore, we will consider that any changes relating to depreciation is change in accounting estimate. So when it is a change in accounting estimate, so we have to adjust the current year. Okay, or we would say the changes take effect in the current year, the year where the changes is made. Okay, so the changes is the depreciation is charged at 25%, using a reducing balance method. So when you want to calculate the depreciation based on the new method, you must rely your calculation based on the carrying value. So you have to calculate the carrying value of the equipment. So the accumulated depreciation is 5 million minus the residual value 500,000 divided by 10 years times with 3 years from 2009 until 2011. So you get accumulated depreciation of 1.35 million. So the carrying value would be 5 million minus the accumulated depreciation. So you will get this one. Okay, 3650 is there in the is in the slide. 3650 36565. Okay, so when you calculate the depreciation, it should be based on the carrying value because this is a depreciation based on the new change of estimate. So you have to calculate based on the carrying value. So the carrying value is 3650. So times with 25%. Also because it is a reducing balance method, depreciation is calculated on the carrying value. So here you will get depreciation of 912,500. Okay. All right. So how do you answer the accounting treatment? So you will say that the change in the depreciation policy from straight line to reducing balance is accounted as a change in accounting estimate. So it should be adjusted prospectively. That is in a period of change. It is in the current year is a 2012 and a future period if the change affect the future years. So in this case, of course, the depreciation will be continuously, the equipment will be continuously depreciated in 2013, 14, 15. So that's why it says here it change in the period of change and the future periods. So in the future, in next year, the same rate will be applied to the equipment. Okay, and then you have to mention the current year depreciation shall be 912,500. Okay, so this is the calculation, and this is how you show the journal entry and the presentation of the carry amount in the SOFP if required by the question. So the depreciation 112,500 is a debit SOPL, credit accumulated depreciation. Next we go to errors. Okay, so errors, there are two types of errors. Either the errors is a current year error. Current year error is where the error occurred in the current year, where we are still doing the financial statement, we have not finalizing the financial statement. Or it can be a previous year error, where the error occurred last year, where the financial statement has been completed, but only this year that you identified the existence of that error. So that is a current year error, or it can be previous year error. So you have to identify which one, which is the error. Okay, so the error can be an omission, it can be misstatement, it can be fraud. Okay, any figures that you have miscalculated, that is also considered as error. So this previous year error, like I explained just now, it can be identified in the current year. So what do you do with the errors? If the errors is material, so material errors of prior periods are corrected retrospectively. Retrospectively means that we have to adjust the opening balance of the equity, because the opening balance of the equity is wrong due to those errors. So we have to adjust the opening balance. That is the meaning of retrospectively. Okay, if you refer back to the change in accounting estimate, it is a prospectively, whereby you just do the adjustment for the current year. Okay. Okay, example of errors: you may have wrongly calculated the figures, you have wrongly added the figures, you have wrongly applied the policy for the non-current asset, you have wrongly mispresent the fact, or there could be a fraud that happened in the organization, in the company, right? So that is considered as error. So current period error is where the error happened in the current year and discovered in the current year. Okay, example is error of omission, commission, principal compensation error, and error of complete reversal. So if it is a current period error, you must adjust it as a year-end adjustment. Okay, before you finalize or close your financial statement, you need to do this adjustment. So it is called financial year-end adjustment for the current year error. Okay, for example, you make payment of 100,000 to your creditor. So the payment was treated as salary. So this is wrong. You should deduct your accounts payable, but you did not do that, but instead you increase the salary. So what you do to correct the error, you need to reduce the creditor account and you have to reduce the salary account. Okay, which is you have to reduce the salary account, credit salary. If you credit SOPL, that means you increase your net profit lah, because when you reduce salary, the effect is your profit will increase, so you can credit SOPL. Okay, so this is called year-end adjustment if it is a current year error. If it is a previous year error, so the adjustment would be retrospectively. You have to do the adjustment on the opening balance of the affected item. Okay, if it is an SOPL item, if it affects the SOPL item from previous year, so you have to adjust the opening balance of retained earning, because if you remember when you prepare publish, the net profit or the net loss will be transferred into your SOCI under the retained profit or retained earning column. So this SOPL will affect your retained earning, and this retained earning will be carried forward to the subsequent years. When it is a previous year error affecting SOPL item, we cannot adjust SOPL item in the current year. Okay. For example, just now the error was you add the salary account that happened in previous year. If it happened in previous year, you cannot add salary in this year. Okay, you have to add the you have to adjust the opening balance of the retained profit. Okay. For example, here payment of 100,000 was made to trade supplier. The payment was accounted as employee salary, and the current accounting period is in 2011. The error happened in 2010. So this is considered as a previous year error. You have to do the adjustment. So you see here, you debit creditors account because you need to reduce the debts, but you don't credit the salary or you don't credit the SOPL. You credit the retained earning because this is a previous year error. Okay, so any previous year error that affecting SOPL item, we need to adjust the retained earning. If you credit SOPL, it means for the previous year error, if you credit SOPL, means that you are adjusting this year SOPL, and that is wrong. Okay, that is not correct. If you adjust your current year SOPL, so the SOPL that you report for this year is inaccurate. Okay, it is inaccurate because you have included some item that meant for last year. So this year-end adjustment for the previous year error, we call it as retrospectively, and we adjust the opening balance of the retained earning. Okay, all right, I stop here.